I've been saying all along that a sale occurs when the goods are delivered. What is meant by delivery? Well, it may seem straightforward, but we live in a global economy where there's a lot of goods being shipped from far away, like as far as China. And there's oftentimes many goods that are in transit, meaning they've been sent by the seller, delivered by the seller, but they haven't arrived at the buyer's place of business. So whose goods are those that aren't quite there yet? Well, it depends on the shipping terms, which were determined by lawyers. So if the terms are FOB shipping point, by the way, FOB stands for free on board, and it's from the perspective of the buyer. So basically, if the terms of the purchase, which is determined by the seller, if it's FOB shipping point, if that's what they stated, then title passes as soon as it leaves the seller's place of business. So if it's FOB shipping point and the goods are not quite there, as soon as they leave the seller's place of business, it is the buyer's property. Now, as far as they would then include it in their inventory, and the seller can basically record the sale, which is what they want to do. Now, if the terms had been FOB destination, what that means is that the sellers are responsible for getting the goods all the way to the buyer's place of business. So the title does not pass until it actually arrives at the buyer's place of business. As far as these terms go, it also determines who pays for the shipping. If it's FOB shipping point, since the title passes right away, it's the buyer's responsibility to pay the shipping and get the goods there. If it's FOB destination, it's going to be the seller's responsibility, and hence would pay the shipping cost to get it to the buyer's place of business. So let's go through some typical exercises you might see. We have an example here where a few things. One is, if you have a purchase, you've got to determine how much do I, as a purchaser, increase my inventory by. Well, it's all cost to get your inventory in place and ready to sell. So you've got your invoice price, that would be part of the cost. But then there's often these terms. It's called a purchase discount, and that is a strange way, a term, in that it's written in sort of this cryptic fashion. But what it means is that if the buyer pays for the goods within 10 days of receipt of the invoice, it will get a 2% discount. So the first number is the percentage discount off your invoice price, and the second number is how many days in which they are offered that discount. The rest of it just says that, well, if you miss the discount, you still have to pay in 30 days. So in this case, if they pay within 30 days, we'll assume that is the case, the buyer would get a 2% discount, and that would amount to $100, because 2% of 5,000 is 100. You don't get a discount off the shipping. Now, who pays for the shipping? It depends again on the shipping terms. And FOB shipping point, that I'm going to scoot back up here. FOB shipping point means title passes as soon as the seller ships it. So that's going to be the buyer's cost. So that would be part of the cost to get your inventory in place and ready to sell. So you'd add the $250. Now, once the inventory is in place and ready to sell, the other costs you cannot keep adding to your inventory. And the advantage of adding to an inventory is that it's going to go on your balance sheet as an asset, whereas these items right here, the stocker, the salary to pay the person to oversee the inventory, that's an expense, as is the electricity. So we have 0 for those. The total debit to inventory for this example is $5,150. All right, now I'm going to have you take a look at this, where often we're looking at year end and trying to decide what's the amount that should be added to inventory. And we have here the price, $5,000. The shipping terms are 2/7 net 30. So if they paid within the week, which they did, because they had 7 days, they get a 2% discount. So in this case, they're only going to pay 98% of the $5,000. Again, it wouldn't be part of shipping. You don't get a discount on the shipping. That's a different party that you're paying that money to. So in this example, they're going to pay 98% of the $5,000, and then it's FOB shipping point, so this is the purchase, by the way. We're taking this from the purchaser's perspective. And that's important. Always ask yourself, who am I in this example? Am I buying or am I selling? And it will tell you that in the problem. So if it says such and such a company purchases $5,000 of merchandise, then you know that you're the purchaser, buyer. Or if it said XYZ company sold $5,000 of merchandise, then you know you're taking it from the seller's perspective. Anyways, let's go through the rest of this. The cost, the debit to inventory in this example is $5,100. In this next one, they get a 4% discount. That's quite generous. And that amount would be 96% then of the invoice price because they did pay within the week. And because it's FOB destination, there is no shipping. The seller has to pay for that. So the cost of inventory is $2,880. The $2,500 in this next one, 2% discount if they pay within the 10 days, and they did pay within the week. So in other words, they did pay in time. So they're only going to pay 98% of it. Now, who pays the shipping? FOB shipping point, title passes at the point that it gets shipped, meaning it is the buyer's responsibility. So the buyer adds that as part of their cost of their inventory. So it's $2,970. Last one. By the way, you might want to pause and then try this one on your own just to make sure you have the idea. So the answer would be, in this case, again, they get the discount. They paid in time, so they get they only have to pay 97%. And since it's FOB destination, the buyer doesn't have to worry about it. It's the seller's responsibility. So it's $8,730. The last thing I want to show now is the cutoff, they call this, is whose inventory is this at the end of an accounting period. And that's really important when you look at a seller, because the seller, often they're trying to make sure they have a good earnings or net income for the period, and they could ship a bunch of goods, but if they are, in this example, let's go with this, if it was FOB destination, the sale cannot be recorded until it actually arrives at the buyer's place of business. So auditors have to look at this very closely to make sure that companies aren't recording sales that actually are not valid sales. So in this case, shipping goods on December 31st, they don't arrive until the next year on the 5th. Should those be included in the, and now in this case we have to decide, are we the buyer or the seller? And in this case, since it doesn't say we purchased it, we're the seller. So in this case, we would not include, we'd have to include that in our inventory as the seller. We are not allowed to record that sale, meaning debit accounts receivable, credit sales, and debit cost of goods sold, and credit inventory. We cannot credit the inventory. We have to keep it in there. It's ours until it's actually arrived at the buyer's place of business. All right, so here we are selling again, but this time it's FOB shipping point. So that is a sale. So they can make that entry that they want, which is to increase their sales and record the cost of the sale by decreasing your inventory. This last one, we're purchasing, so we got to look at it from the buyer's perspective. If it was bought FOB destination, it means it's not ours until it actually gets to the destination. So in this case, we would not include that purchase. You would not debit inventory and credit accounts payable. Now, as far as I'll go through another video where I'll show you the effective cost of not taking advantage of a discount.